Hey, everybody. Welcome back to our monthly market update. I'm Brad Gotto, founder and CEO of Fiat Wealth Management. And as always, I've got my buddy Tim Holland, Chief Investment Officer for us here at Fiat, as well as the broader Town Square world, Orion world. Tim, as always, thanks for taking the time to be here with us.
Yeah, no, it's good to be with you. As we were talking pre-recording, you guys survived the Waste Management Open.
I'm here.
Yeah,
I
you
live
made it.
to tell the story. My boys live to tell the story. It was a good event. It was fun.
Yeah, no, good to see you. Glad everyone's doing well.
How was your month?
Yeah, it was good. The weather's getting a little warmer here in PA. Sun's out. Took my son snowboarding a couple, three times in the Poconos. Small hills, but they had a good season. It's not Utah or Colorado.
You didn't tear, rip, or break anything, did you?
No, yeah, it's real. You got to work really hard. I mean, the elevation's kind of, which is good for me. You get older, flat skiing's not so bad.
Yeah.
But that was good. Kids are good. Yeah, lacrosse is heating up, so looking forward to spring. I assume baseball is
Yep.
going to start picking up
We
with you
just
guys.
ended basketball. Son just had his state basketball tournament. Unfortunately, they didn't fare too well, but
Sorry.
we had fun anyway. And baseball tryouts are in a week or two. So
All right.
I was just talking to my wife about that. We were looking at the schedule this weekend, and there's nothing, not nothing, but there's relatively nothing in it, which is compared to we get these random week off tendencies between sports. But it's also the Big Ten women's basketball tournament this weekend, and you can't get a ticket. It's up here in the Twin Cities because of the Caitlin Clark effect.
Yeah, so, you're an Iowa guy, right?
Yeah, I'm diehard Hawkeye. So
yeah, she's incredible. There we go. There it is. Got it. She's incredible. Past Pistol Pete,
so, I might try to get down there and get to one of those games. It's funny because they hosted last year up here in the Twin Cities, the same tournament, Big Ten tournament. It was right. Caitlin Clark was a name for sure, but until that title game against LSU, Angel Reese, that whole thing, she wasn't kind of the phenom that she is now. And so we were like, paying $20, sit wherever you want, like general admission, right down by the court. Now, and the upper bowl of the Target Center where the Timberwolves play, where they hosted, was closed. It was just lower bowl was open. Now you can't get a ticket.
Wow.
And deal. Some of them, the nosebleeds, my wife was just looking are like $200. So capitalism, man.
Listen, you start draining threes from 4.5 miles away, ticket prices are going to start going up.
That's wild. You talk about. I mean, we're here to talk about monthly market stuff. And, which is money related. But man, you talk about money in college sports and NIL and how the landscape is changing there. And
I don't understand a lot of that. And I know there's some outstanding legal cases, and there was just a recent decision involving it. It seems to me like the NCAA has got to create some structure, rules around some of that stuff, or
we'll see how it goes.
Yeah, every good athlete's going to wear.
It's one of the reasons that Nick Saban was chased out of college football. He admitted the other day.
It seems like it's a little too much, but
all right. So everybody's here.
Sorry. Yeah,
that's fine. I'm the one that derailed us. Don't apologize. You got me talking about Caitlin Clark and the Iowa. So that could go for hours.
Let's go.
So that being said, if this is your first ever monthly market update, our format is we take a look back at the last month. We're going to take a look ahead at the coming month, and then we're going to pick one data point that we think is interesting and discuss that a little bit. And then I'm going to try to leave you with one final thought. Kind of, this would be a cooler story if I could come up with this guy's name. What's the most famous radio broadcaster of all time? What's his name?
Edward R. Murrow?
That's a good name too. Not the who's the guy that always left you with that one final line?
The rest of the story?
Yes.
Oh, shoot. Oh, fudge.
The people that are watching this are screaming at the screen right now. They're like, not Howard Cosell.
And that's the rest of the.
Yeah, that's what I was trying to get.
Yeah, all right. I can Google that while you're setting.
My excuse is I'm in my 40s. I don't know what yours is, but
my excuse, I should know. I'm old enough.
All right. 3 points. A look back. We're calling our look back point. Get in
Paul
line. Harvey. Thank you. I knew there was an H. I couldn't remember if it was his first name or his last. Paul Harvey. So I'm going to leave you with my Paul Harvey thought at the end.
Yep.
All right. A look back. I'm calling it get in line. And the reason I'm calling it get in line, and this has been kind of a prevailing thread in our recent market updates, is the Fed and the fact that the Fed and the markets weren't in agreement of what was going to happen in 2024 relative to the Fed's reaction to interest rates and what they were going to do, leave them, lower them, raise them. If you haven't watched the previous ones or you forgot, the market kind of had priced in 6 rate cuts. The Fed was kind of pricing in 3 rate cuts. The market has basically now acquiesced to the Fed and said, look, we get 3 rate cuts is probably the right number. That would lead me to believe, Tim, that the market overpriced in the cuts, which is a positive for the markets. So the market should have pulled back.
Yeah.
Once they realized that that wasn't going to happen. I haven't really seen that. Yeah. So what's going on?
Yeah, no, that's a big deal, I think, getting the Fed and the market on the same page. If you go back to so the Fed started raising rates 2 years ago, March of 2022. They finished July of 2023, assuming they are done, and by all accounts, they are done. And if you remember, some of the worst days for the market sort of going through 2022 and into 2023 was when the Fed met and came out and raised 75 basis points and the market was expecting 50, right? Or Jay Powell came out and was super hawkish in a press conference when the market was expecting, okay, we're already, at 4% on the Fed funds rate. Can we start to slow this down a little bit? Obviously, we got all the way to 5.5%. So that misalignment, in my opinion, can be a source of volatility because it's all about expectations, right? You think about earnings season. Did the company meet expectations? Okay, good, great. The company didn't meet expectations. Investors are usually not that happy. So getting to the same page, I think, eliminates to a certain extent a real source of market volatility. But that also, so if you check off that box, you get to your question, which is a big one, which is the market likes cheap money. How come the market hasn't sold off? If we're not going to get 6 rate cuts, we're only going to get 3. Right. And that's because I think the economy has just continued to prove to be a lot more resilient than people thought. We got that great January jobs number. That surprised to the upside. We'll get the February jobs number tomorrow. We'll see. And on balance, the economic data has been pretty solid. So that's created this backdrop where Jay Powell's been able to credibly say, we're going to cut rates this year. He's saying the same thing this week in D.C. He's testifying before Congress. But we're not going to go in March, which is what the market expected, and we're not going to go 6 times. So I think the still good economic data, but not overheating economic data, has helped sort of fill in that missing, hey, we wanted 6 cuts, we're only going to get 3. Here's why we're not disappointed. Earnings and economic data have been okay. Not phenomenal, but okay enough to kind of solve for that 75 basis points to the 3 rate cuts that the market's not going to get, gotcha. Which kind of speaks to this, at least for now, soft landing, pretty good scenario. Modest economic growth, moderating inflation. The Fed can cut in the back half of the next year, sort of knock on wood.
So long story short, bad news offset by some other good news kind of just leveled everything out.
Yeah, well said.
Lovely. How about a look ahead? So I'm calling our look ahead point politics, earnings, and the Fed. Oh my.
Yeah.
There's a lot going on in March is basically what I'm getting at. We've got, Super Tuesday just happened. Politics are heating up, right? We've got that storyline going on while we have earnings season coming to a close, while we have a Fed meeting at the end of the month that nobody's really even talking about, which the Fed has been in the spotlight for the last couple of years. And it seems like every time, they get together or Jay Powell opens his mouth, it is a big deal. But right now it's kind of being overshadowed by some of this other stuff like the earnings season and the political environment that we're facing right now. And so I guess my question is this, with all that going on, and all the kind of these big, significant rocks that we're dealing with, what is your expectation for March or kind of coming into April, and how the markets might react?
No, I think you're right. Super Tuesday was a couple of days ago. We're sort of where we all thought we would be, which is Joe Biden, Donald Trump, right? There were a couple marginal candidates on the Democratic side, including a congressman from the great state of Minnesota, if memory serves. He didn't get very far, so it's Joe Biden's nomination. Same thing with Donald Trump, though I think he's got a couple more delegates he has to win. Nikki Haley is suspended her campaign. So I do think, even though we've talked a lot about politics not really impacting the market in a meaningful way, source of volatility short term, I do think with the Fed saying, hey, we're not doing anything until the middle of the year, I think the focus is going to be on the presidential race. There's, I don't know how much more we can say at this point, but I just think that's where the media is going to be now that, it is a Donald Trump, Joe Biden rematch. President Biden has the State of the Union address tonight. I'm a political junkie. I like following this stuff. I think he's got to give a really good speech. If you look at the poll numbers of late, he's not in a good spot, especially in the 5 or 6 states that are going to decide the election. And so I think, barring an inflation shock that brings the Fed back into the conversation, I think the Fed, even though they're meeting this month, to your point, is going to sort of fade from view a little bit. It's going to be all about politics. It's going to be about DC trying to deal with some of these spending issues because they're still working off of interim agreements. They've got to solve for that. That's a source of volatility, especially with this dynamic in the background of Biden-Trump. How does that influence Congress and their willingness to do a deal, right? Again, we're heading into a very, very contentious election cycle. So my 2 cents would be earnings have been good. We're going to finish off Q4 this month. They've been better than expected. That's great. I think the Fed fades from view. I think it's going to be all politics, even if we're all going to be regurgitating the same story, which is if you love Donald Trump, Joe Biden's the worst thing that ever happened to the country. If you love Joe Biden, Donald Trump's the worst thing that ever happened to the country. And just be prepared, I think, for a lot of yelling and a lot of vitriol, and don't let it impact your thoughts around the markets and the economy, in our opinion, because I think it's going to get really. I think now is when it starts to get really unpleasant because we know we're finally at that rematch kind of kickoff.
Yeah, very good point you made it there at the end that I just want to regurgitate, which is don't let these politics overshadow long-term financial markets and the free market system that we find ourselves in. There's always short-term volatility because of politics, but long-term viability of our markets is not dictated solely by who ends up in the White House. And more than almost anything, Tim, I would argue that you get families that have opinions, obviously, on this kind of stuff, let alone any other type of economic data and why they want to make decisions based on their investments and their piles of money on who's going to be in that office. We get more than anything. When in reality, these things all kind of level out. So keep your eye focused on the prize or the ball or the finish line, which is the outcomes you're seeking with your pile of money, and not short-term volatility relative to people's emotional reaction to what's going on in Washington. So
to your point, and I don't have the data in front of me, so I apologize, but we've got a chief behavioral officer who looks at psychology and markets and how those two dynamics interact. And there have been studies that have shown Republicans, people that self-identify as Republicans tend to trade more when there's a Democrat in the White House, and people self-identify as Democrats tend to trade more when the Republicans in the White House, because that political bias kind of bleeds into, oh my gosh, this person's ruining the country. I've got to do more, get out. And again, typically, you want to be in the market, keep your eye on the prize, the long-term goal, the plan, because it's been quantified. It has an impact on investor behavior, and usually not in a good way. So I think you're spot on.
Lovely. All right, a data point worth discussing. I'm calling this point the broader, the better. The broader, the better. And I'm bringing this up because last year, when you look at the markets and like the S&P's overall return, it can get a little scary if you understand where that return came from. And what I mean by that is of the 500, 506 stocks in the S&P, I think. There's not 500, right? 506. 86% of the return that was generated out of those 506 companies came from 7 of them, which is what, 1.5%?
Yeah, it was the most top heavy index. Made up the most narrow year in the history of the index.
Yeah, so 1.5% of the components of the index made up 86% of the index's return. That's not ideal, right? We want the broad economy to be healthy, not just a handful of companies. And of course, this year we've got the NVIDIA race going on. The idea or thought of a company in this short of amount of time, adding, what is it, 200, what is my numbers? 227 billion of market cap. Was that the number?
It's about 277 in a single day. When they reported earnings
That's right.
about a month ago, the market cap jumped $277 billion in a single trading day, which was a record for the U.S. Stock market.
Bonkers.
Bonkers. Yeah, it's crazy numbers.
So why the broader the better? Because we're finally starting to see at least some good data relative to the bull market that we're in, broadening out beyond just a handful of companies. And the data that we're pointing there is to the Russell and the small cap space. Can you speak to that?
Yeah.
What's on there?
Yeah, so last year, the Magnificent Seven, to your point, the biggest companies in the S&P 500 drove a disproportionate amount of that 26.3% return. And as you know, Brad, what investors like to see is sort of the troops in front of the generals, the small cap companies beating the big cap companies, or at least keeping up, because it speaks to the fact that more and more stocks are finding capital and are moving up, and that usually is a good thing for the length of a bull market. And we're in this bull market that got going last June. And so at least on a short-term basis, the Russell 2000, which is the S&P 500 for small companies, it's the index for U.S. small cap stocks, is beating now the S&P since late October, when the market bottomed and started to move higher. So that's encouraging. And on a trailing 1 month basis, is up about 7%, which is a pretty extraordinary return in 30 days. And the S&P is up about 3.2, so more than double what the S&P has done, at least on a trailing 1 month basis. So it just speaks to, again, sort of a broader, deeper, healthier move up in risk assets. And small stocks are still pretty attractively priced. If you look at traditional valuation metrics, they've lagged big companies for a long time, even though they tend to do better over the long term. So we're pretty encouraged by that. And we do think that's a really good sign, sort of knock on wood, as it concerns the potential breadth and run of the current bull market.
Yeah, and I think we talked about this a little bit offline too. Interesting, in spite of the fact of our first point, get in line, which is the market is now acquiescing to the Fed's less than aggressive rate cutting, which is actually more of a positive thing for small cap companies than it is large cap companies, because that means borrowing costs come down, which is more impactful to a small company. And now that the market has basically said, hey, we realize that they're not going to do it as aggressively as we once hoped, you would think that's going to impact the small cap companies in more of a negative way than would these large companies. And in spite of that, we've seen pretty good data there. So it's encouraging to see
for sure
kind of the broadening of that space. So awesome. With that being said, the March Madness tournament is coming up, so I'm going to put you to task. I know you're not a big basketball guy. We talked about this.
Yeah.
But are you a March Madness guy at all? Number one.
I have been in the past. I never win anything. I've lost money on those brackets. But so I know maybe enough to be dangerous. I don't know. How about you?
I've seen economic data, and I don't know the exact number, so I'm not going to quote anything. But long story short, the two opening days of March Madness tournament, which are Thursday and a Friday, are the most unproductive days in corporate America in the entire year. Like like publicly traded companies lose billions of dollars in productivity in those 2 days.
I believe
I'm a huge March Madness guy. It's like a religious experience for me.
Yeah, I've got friends who still get together with their high school buddies and college buddies. They'll pick a city, meet, watch a couple games, or go to Vegas and stand in front of those huge screens. And Warren Buffett, for the longest time, I don't think he does it anymore. He used to, through Geico, I think, is his largest insurance company. Would pay out $1 billion for a perfect bracket, not getting the national champ, and no one ever came close. Whatever the premium was, he made a boatload of money for years, and then he finally stopped doing it. But yeah, I mean, obviously a lot of folks get the national champion right. I don't think there's never been a perfect.
There's never been a perfect bracket.
Yeah, and that wild. You would think with all these people and all these brackets, at some point, just kind of dumb luck. But who do you think's gonna?
Here's why I bring it up, because to me, March Madness, as fun as it is, and as fun as it is to talk about and wax and wane about teams and all this other kind of stuff, every single year there's a surprise that nobody saw coming. Every single year. And as much as you and I like to wax and wane, I think it is positive to put out these monthly market updates, which is exactly why we do it. It's fun for us to have these conversations and people to understand kind of what's going on in the broader world around us. It leads me to the end of what I'm going to leave you with, which is we never know.
Yeah.
And while we may be right that we're net in a bull market this year or in a bear market, or that the markets long-term go up, we don't know how things are going to move around in the middle and how those 64 teams or 68 now are going to whittle themselves down into the national championship. So you led me in there perfectly, in that people get the national championship right all the time, but every step along the way of what led to there has never happened before. It's never happened in the market either. A year into the Great Depression, people still didn't know they were in a depression, as an example. Yeah. It wasn't even until hindsight. But that being said, as fun as it is for you and I to wax and wane on this kind of stuff, and sometimes even get poetic about it, that's why we invest in long-term markets. That's why we stick around for those long-term markets, and that we are consistent and boring. Yeah. My ideal portfolio for the families that we serve is like a paint drying, boring level portfolio. Yep. Because that's how we win the game, is we just stick around. Sure. You got to be in the game to win the game. Warren Buffett says the 2 rules to investing are to get invested and to stay invested. You got to stay in the game. And so all that to say, with what you mentioned, and I'm going to probably say this every month until November, with this big political environment coming and all the emotions that are going to go along with it, no matter which side of the aisle you fall on, always remember that your advisor, if you have a good advisor, should be unemotional and unattached about all of that stuff, because I have no control over that. Nobody else does either. And quite frankly, how the markets perform in the short term is almost irrelevant to long-term outcomes if we're positioned correctly. So, Tim, super fun. Always super fun. Thanks again for taking the time to join us for our monthly market update. I can't wait to get back together in April. After this month of crazy March has kind of played out, and see what happens. It's going to be a lot of fun to talk. In the meantime, enjoy the rest of your March, and we'll talk.
You take care. I'll see you in April.
Cheers.